And so people are talking about it, and so it's kind of hard to escape the fact that stocks are really volatile, and then when you sit at home, you think, well, what does that mean for me? And I think that's the scary piece of the personal finance piece of this, right?
Yes.
So all this is happening out there.
Yeah.
How does that affect my retirement or my savings fund or whatever?
Especially this time of the year too, because people are perhaps more aware of what's going on or more aware of these headlines because of RSPs. Like, it's just a time of the year that people are thinking about this stuff more than usual. Not that, I mean, I'm sure you would say we should be thinking about that all year, but...
Yeah, but you know, in the summertime, who's really thinking about the RSPs?
Yes,
but
true.
But if you're just sitting on the sidelines and you're just about to send money to your financial institution to invest, and this is happening, that's like, I do think that RSP season has kind of put this on steroids, right? So it's like, do I even do this?
Yeah.
That's a scary thing, right? So
Yeah.
I feel it. I feel for people. I feel for everybody. It's scary when this stuff happens.
Yeah, no, I mean, I think it's what you hear from, although we did, you know, chat with some people on the street downtown Toronto here, and they're talking about trying to stay calm and that they're in this for the long term.
Yes.
But that is what we're talking about today. We're talking about the stock market volatility that we've seen in the past few days and what this could possibly mean for your financial future. I know that people have a lot of questions out there, so please send them our way. So I'm here today with Shannon Lee Simmons. Shannon is the founder of the New School of Finance. She's a certified financial planner and the author of Worry-Free Money. So just a bit about you before we get started.
Sure.
So you're a fee-based financial advisor.
Yes, so fee only. So that's
fee only.
Yeah,
right.
so that's an important distinction just because I don't actually manage assets or sell product. So totally unbiased financial advice.
Yeah, so we're not talking about what you should put in your portfolio or whatever it may be, but trying to take a big picture look at what's happening and what this could mean for you.
Yes.
So send in your questions and we will try to answer them. And I just want to start with just what questions you're getting. So what are your clients, you know, are you getting calls? Are people nervous? What are they asking you?
Yeah, so I'm getting lots of emails.
Yeah.
And so most of them are just sending you links from the internet saying, is this something I need to be worried about? How scared do I need to be? And I think that's what we can really dive into today is like, is this something that I should be staying up at 3 in the morning and being like, or should I just breathe through it? So that's and it's a very complex question, and I'm sure everybody's situation is a little bit different. So off the top, I would say, with my clients it's different because I am their financial planner, but like for everybody out there, if you're feeling nervous and you have a financial advisor or financial planner that you work with, like it may be time to pick up the phone or write an email to them and just get a pep talk. That's part of their job, right? Is to like manage that relationship and like help you through those moments where it feels a little bit scary, right?
Yeah.
So people are nervous.
Yeah, well, I mean, we saw, it's hard not to pay attention when the headlines are talking about these 1,000-point swings in a day, and it's something that we just haven't heard about lately, right?
In a long time.
So that adds to it.
Yeah, and there's been really good gains on the markets for the last few years overall. Last year was really not that volatile, and then all of a sudden you have this, headline noteworthy day of correction. And so, but you know, in context of the history of the Dow Jones, in a percentage basis, it was only a 4.6% drop, which, you know, in the context of history is not even that scary. So there has been scarier times out there, but what I'm finding a lot of too is that because the last, 5 years have been generally good, people aren't used to getting shaken up like this. So it's one of those financial realities of like, this is a normal part of investing, but if you have been a first-time investor maybe in the last few years, this might be your first time feeling that stress of watching in real time your money going down if you're like opening up your accounts and stuff. So oftentimes I'll tell people to like stop opening your statements, don't check your banking, take the app off your phone. If you don't actually plan on doing anything, then sitting there watching it isn't doing anything productive.
Right.
It's just making you more nervous. So everyone just needs to chill.
Yeah, and I'm gonna do I'm probably gonna do the thing that you'd say not to do, but I'm just looking at the Dow right now and the S&P 500 and NASDAQ, and things are positive today. Things are relatively calm after what we've been seeing in this sort of roller coaster week. So, perhaps don't stare at those all the time, but interesting to check in on them today. But we do have some questions coming in, so keep sending them. So Joe Phipps Thomas asks, will this dive in the market affect the percent rate on mortgages? So I don't know if there's a way to look at how... I mean, we're talking about interest rates.
Yes.
Potentially rising in the U.S. and that would impact the borrowing of banks. I mean, all of these things are related in a way, but
yes, and that's also definitely a forecast that, like, no one has a crystal ball. But what I think is important to note is that what the Bank of Canada does when they raise general interest rates usually does spill over into mortgages, right?
Yeah.
With the key lending rate. And so if the banks, even in Canada, decide to raise overnight rates, then you could see that in your mortgages, which they've already said that maybe they're going to do. So it may happen. I don't know if it's particularly like because of Monday, now the Bank of Canada is going to raise interest rates.
Yeah, and you know, that's a good point. We can't forecast anything. We can't forecast what the markets are going to do today.
I forgot my crystal ball.
Right, exactly. We have more questions. So there's Jennifer Alvarez asks, and we've talked about this a little bit the last time you were on, but do you think Bitcoin is the wave of the future? Because it's one of these investments that some people have been talking about more and more lately, but it is also a very volatile one.
Totally. So if you were into the volatility on Monday, then that might, if you were really excited by that, then maybe you can handle, like, then maybe something like a speculative stock or a speculative investment might be something that you would want. But I'm not going to say that Bitcoin is the future because I don't know. What I would say is that I would treat Bitcoin or any cryptocurrency just like a regular alternative speculative stock. So if you're a person that would want a small bit of your portfolio in something so volatile and speculative, then maybe that's something that you want to dig into. If you're a person that is like, that is terrifying to me and I don't like that much potential volatility, then maybe not. So just treat it like it would be any other speculative stock.
Sort of a
very small portion to begin with at all, if at all.
A sort of, I think you had referred to it almost like a fun money, like it's okay if
it went to zero. So if you were curious about it, don't use an amount of money that's material in your life. So if you invest in any sort of speculative stock, not just Bitcoin, anything, or a speculative stock, be okay if it goes to zero, and then you don't have to have any worry about it. It won't keep you up at night because it's only really an experiment.
So we are talking about all the volatility that's been happening on the markets in the past few days, and I know that our readers and our viewers of CBC Online, of CBC News Network, all of that have tons of questions. So please send them our way. We're talking about the personal finance part of this, so what this could possibly mean for you. And I know we're live on the CBC News Facebook page and Twitter and YouTube and On the Money. So bring it on, bring on all your questions. So we hear from Philip Giglio, and Philip is saying, just commenting, let your stocks and bonds ride it out. So let your investments ride it out.
I don't disagree with that. So I guess you can't just say a blanket statement for every single person, but what I think is important about having these kinds of discussions and what it means for your personal finances is that any money that, let's take a step back and think about what is the money doing in those accounts? Why is it in there? Why is it invested? So any money that should be invested in the first place versus sitting in cash should be money that from the get-go, whenever you decided to invest, should be for the long term. Should not have a short time horizon. So I'll give you an example. If you're saving in your RRSP for retirement, maybe you're 10, 15, 20 years out to retirement. That means that you have a long time horizon, which means that you can ride those up and downs without panicking, selling, and emotionally reacting to any sort of blip or volatility in the market. If you've got a short-term time horizon, so let's say your money is in your RRSP because you are planning to buy a house in the next 6 to 9 months, and $25,000 of that is for your first-time homebuyers plan, that $25,000 should not be invested at all because market volatility is a super normal, par for the course part of investing. And so if you need absolutely every single dollar in a short period of time, you don't have that time to wait it out and wait for it to come back up. So when you're thinking about like, how nervous should I be and what does this mean for my personal finances? If the money that's invested is money that you don't need for a long time, that takes a lot of the heat off, right? Because if we look over time, markets go down, markets bounce up. Markets go down, markets back up. It's very normal, par for the course. So you shouldn't be feeling so panicked about it. So if you are feeling panicked, maybe it's because you need that money in the short run, which means it maybe shouldn't have been invested in the first place.
So Shannon here is a fee-only financial advisor. She's the founder of the New School of Finance and also an author of Worry-Free Money, new book out. And this is a question about financial stress, so tying to that perhaps. But Kitty Armstrong is asking, I was taught long ago that in times of financial stress to not do a thing. Am I too casual in my approach, and kind of what we were just talking about. But
yeah, so I think that there's an old saying that's like, when in doubt, do nothing, which is kind of along that. So I think it would depend on the context of, you know, what's happening and why are you stressed out. So if it's in the context of market volatility, and like we just said, it's a long-term investment and you have an investment plan that you feel good about, it matches your risk tolerance, matches your goals, then yeah, I think that taking a step back, blocking out the noise of a lot of the fear mongering that happens sometimes, and just sticking with your plan in like a diligent way. Yes, so I mean, you could translate that into doing nothing. However, you know, if you have debt and interest rates are rising, you may not want to just not do anything, right? You might want to be like, whoa, let's fully attack that debt because interest rates are rising and I don't want to have that cash flow crunch that might come with that. So I really think that within your personal finances, there's a time to just stay the course, and there's a time when you need to jump into action, and it just depends on the overall holistic picture of your finances and like what you're able to do and which levers you can pull.
And I wonder if at times like this, it's actually an opportunity to, you know, because we've had a few good years, if it's an opportunity to step back and think, was this risk something I was comfortable with?
Totally. I love that you said that. I find that, and anytime I am doing any sort of financial education with people about how to invest, or like what does it take to invest and what is the investment market, I always say everyone has a bullish, high risk tolerance when markets are going up, right? So it's really easy to say, yeah, I can handle market volatility so I can get some growth. Check, you know, that little spreadsheet that everybody makes you fill out, your KYC. So it's really easy to do that when your friends are talking about all the gains that they've had and things are good. When you really find out your risk tolerance is in a bear market or correction or when there's volatility, that's when you find out truly what kind of investor that you are. Because are you the type of person who's checking every day and panicking and wanting to sell and like sweating, in which case you were probably too risky for what, like your risk tolerance was much more conservative than what you thought that it was. And that's a really good opportunity to learn. And by the same token, if this is something that just makes you feel like, yep, I get it, I'm in, then you were right on the money with potentially your risk tolerance, and maybe you are genuinely a high risk tolerance.
So we're talking about, you know, all of this roller coaster ride that we've been on the last couple of days on markets. We've seen the Dow, you know, plunge and then rebound, and it's been quite a couple of days. We do have more questions coming in. I see one from YouTube. I see Jersey Joe, another one from Jennifer. So we'll try to get to all of you, but keep sending them our way. Shannon Lee Simmons is a certified financial planner and here to help us, you know, wade through all of this. So we'll go to this YouTube viewer, and they're asking, is there any advantage of using online brokerage companies, such as Questrade, for stock or fund transactions rather than using banks?
So I think that this is just a question of fees and service. So regardless of the financial institution, whether it's an online brokerage or whether you have an online brokerage within your bank, because all the banks have online brokerages too, typically when you're doing a brokerage account, it's because you're doing your own investments, right? So you're the person that's like buying and selling products or buying and selling bonds and stocks and securities. So at that point, I would say I don't think that there's an advantage to one or the other unless you look at the fees and the type of trading that you're going to be doing. So really think about your portfolio. How hands-on are you? Are you trading a lot? Are you trading once a month? Are you trading once a year? Like, what is it that you do? And then just compare fees. So look at the transaction fees and maybe also the minimums. I think that's a big thing to compare too. So if you have so much money that you get waived of your fees, then that would obviously be a brokerage account that would be a good fit for you. Whereas like if you are just starting out and maybe you don't have that much, maybe different financial institutions will have different fee breaks for people. So I would do that. And then the last thing I would check in is, are there any commission breaks? So sometimes what online brokerage places, banks or online, so any brokerage, they might discount certain types of products or ETFs depending on which ones you're buying. So if those are the products that you want and they've got them for less money at this brokerage, you might want to do that.
And then it comes back to what many of these conversations come back to, and it's your personal financial situation applies to every, you know, all of these questions. We have another question. So Jersey Joe is asking about interest rates, and it's something that has been talked about so much lately because of what's going on.
Yes.
So Jersey Joe asks, do you see interest rates being a factor to government bonds? A bit of a big question, but...
It's a big question.
Yeah.
So typically the relationship between interest rates and bonds is that when interest rates rise, the opposite happens with bond prices, whether it's corporate bonds or government bonds. And so yes, there would be likely an impact if interest rates are rising, then the actual price of a bond might drop because it makes the value less. But that doesn't mean to say that that's it. If interest rates rise, no bonds. It's all about having that balance between it in an asset mix. So I think actually all of these questions, whether it's about interest rates or market volatility, has to do with somebody's asset mix. What your asset mix is basically how many bonds or fixed income and how much equity or stocks that you have, and is that balance good for your risk tolerance and good for your time horizon, right? And so that's all part of an investment plan for your money. And so if you have that plan, and it comes back to that strategic asset mix that you are yes, this is me, this is my plan, then rises and falls in interest rates, which are beyond your control, and rises and falls in markets, which are also beyond our control too, shouldn't keep us up at night, because we're in this for the long run. Whether it's a rise in interest rates or a drop in the market, that strategic asset mix is really the question. So I would say, talk to your planner, talk to your advisor, talk to somebody who has maybe helped guide you into where you're at right now, and just say hey, I'm feeling really scared. Maybe my asset mix isn't really super reflective of my risk tolerance, or maybe it is and I'm just panicking and I just need a pep talk.
Right, exactly. Good old pep talk.
Good old pep talk.
We're talking about market volatility, and Marion Springer is asking about this. So most of the discussion has been about U.S. volatility, what's happening in Canadian markets. And when you look at the Toronto Stock Exchange, over the last year, we just haven't had the same types of gains that they have seen in the U.S. So over the last year, we're almost flat. So it's not, we haven't seen the same losses, but we also haven't seen the same gains. However, your average, Canadian investor would possibly have exposure to Canada and the U.S. So it's not as though stuff that happens in the U.S. only, affects American investors or vice versa. So so it's kind of, I don't know if you have anything to add to the Canadian
I think
aspect
that's
of it.
Exactly it. So you want to come back to that asset mix piece, right? So it's not only is it just how much fixed income or bonds, that's I use them interchangeably sometimes, or equities or stocks. Within the equity portion of your portfolio, usually you have Canadian equity, US equity, and international equity. So it's diversified, which is a good thing. So just because your US equities might be doing one thing, hopefully you're diversified enough. But typically as an investor, if you've got money in a balanced mutual fund or a balanced account, something like that, it's likely that you have, it's not like it's isolated to the U.S.
Right.
You'll be affected by that too.
So Shannon Lee Simmons is the founder of the New School of Finance. She's a fee-only advisor, and she's also the author of a new book, Worry-Free Money. And we are talking about perhaps some of your worries that you're having over the past few days, which are pretty normal, considering we haven't seen this type of volatility on the markets in quite some time. So it's catching people off guard perhaps a bit.
Yeah, I think that, and also why I think interest rates are scaring people, it's the same thing. So for a very long period of time, we've had relatively good gains in markets and relatively low interest rates, so times have been good. And so now it's the fear of rising interest rates is coming, and we have our first headlining day of market volatility in a really long time, where it's making news, right? And so that hasn't been that way in a long time. So a lot of people who maybe bought homes or invested for the first time over the last little chunk of time, this is the first time that the financial reality of sometimes, that's scary.
Yeah.
Right?
And that's a really good point.
Yeah.
Because people are facing, in Canada, we're seeing mortgage rates go up, and so that potential, and then seeing perhaps your money, if you're watching closely,
Don't watch.
perhaps seeing your money disappear. But Paul Blankenship is asking, what caused the sudden drop and what caused the level off of the market? So, Paul, we've been trying to figure that out for the past few days, but where seemed to have started was last week. There was a U.S. jobs report, and it showed a lot of strength in jobs added to the economy there, and also strong wage growth. And the potential for that wage growth to push inflation higher had people thinking that perhaps the U.S. Federal Reserve is going to raise rates more times than what markets had been expecting. So if rates go up, it gets costlier for companies to borrow money. Perhaps they're spending more on wage growth. So
consumers go down.
Yeah. Right. So all of these things kind of came together, and that's when we started to see the slump happen late last week on the markets. But oftentimes, experts were talking to me about it this week and saying, volatility breeds more volatility. So yes. When, emotions get involved, yep. But also computer trading programs and algorithms and all sorts of stuff, it can compound those dives and also the rebounds as well. So there's a lot going on, Paul.
There's a lot, yeah. And that confidence piece is a huge part of the sell-off mentality, right? So that's why everyone just chill.
Yes, right. Yes. So DW is asking another question. DW asks, what are safer types of investments in a volatile market where a market is on a downward trend?
This is a question you can't really answer.
Yeah.
So an investment, whether it's bonds or stocks, by its very nature has market risk. So they can be up sometimes, they can be down sometimes. So there isn't a investment where there's 100% protection from the downside risk, or else it wouldn't be an investment. It would be cash, which would be something like a GIC or a high interest rate savings account. So, but those aren't investments. That's keeping your money in cash, right? So there isn't actually a place where you can stash your money that's going to give you really good returns with absolutely no risk. If there was, we'd all be retired. So what I would say to that is, instead of maybe looking for the type of investment that's going to grow your money with and also have protection on the downside, I would say come back to that asset mix piece and revisit, what is making up your portfolio. So how much fixed income, which tends to be a little bit less volatile, historically speaking. Again, no prediction, no crystal ball. But it goes up and down, but maybe by less swings. How much fixed income do you have? How much equity do you have? And is it well diversified? And maybe rejigging that asset mix is what's going to provide you with an opportunity to grow your money, but still less potential volatility depending on what types of assets that you have. So that's not necessarily what investment type. It's more about an asset mix question. Because the only options for no downside risk is cash, and cash is great for short-term savings, but that's not where you want to park your long-term savings.
If you have any concerns or worries, or you're nervous about what you're seeing happening, in the headlines, or watching stock markets, which I'm still watching on the corner of my screen here. It's still in the green at the moment. But if you have any worries or questions, send them our way. We've still got a few minutes. We're going here. We've got Shannon. We're lucky to have Shannon here today, helping us through all of this. So send your questions our way. I see one from Tina Bell here. So Tina Bell is asking a mortgage question. So my mortgage is up for renewal. What happens at that time? I'm not entirely sure what she's getting at there, but
well, usually at renewal, if you still have a balance owing, it's a chance for you to renegotiate your contract with your financial institution or your lender that is giving you that mortgage. So what you want to do is shop around for a better rate if you're able to. Maybe if you have some money that's sitting on the sidelines that you are not sure what to do with, you would talk to somebody about maybe, okay, if this is for my long term, do I invest it or do I put it on the mortgage? It's an opportunity to do that as well. So it's actually, when your mortgage renews, it's a really good time to take stock of what your housing plan is and your mortgage strategy. I would talk to your broker or your mortgage agent, whoever signed that on originally, and make sure that you shop around. So a lot of people don't when it comes to rates, and especially with rates rising and everyone's really nervous about that. It doesn't hurt to take some time before you actually sign back on with your mortgage, which is the path of least resistance, to stop and shop around and say, hey, could I get a better rate? Because when we're talking about a couple of percentage points on hundreds of thousands of dollars, it does matter, especially if you're going to lock in. So I think it's time for you to get some advice from a mortgage specialist, and I would also shop around a little bit before you re-sign on with your mortgage.
And I have one last question for you, and this is because we're at this time of year when people are thinking more perhaps about their RSPs.
Yes.
it's difficult to answer this, but what should people be considering when they're, if they were waiting to do something, if they were about to do something? I've heard some people saying, I'm not gonna jump in and do anything right now. Do I change my plan? What should people be thinking about particularly at this time of the year? And it's a very Canadian question.
Yeah, so RSP season is the first 60 days of the calendar year, and any money that you contribute to an RSP, you're able to lower last year's tax bill, right? So that's the big push. That's why everyone's all excited about RSP season.
Right.
So the first thing that you want to think about, if you were planning to put money into your RSP for RSP season, I would suggest that maybe we don't stop everything and put the brakes on, right? So first of all, let's make sure that it's something that is good for you. So should you put money into the RRSP? First of all, that's something that you want to figure out. And my quick check-in there is that if you put money into the RRSP, do you still have emergency savings on the side? Can you still pay your tax bill? Can you still do all those other things? Because a lot of times I see people, just liquidate any amount of money that they have, put it into the RSP, and then they still have a little bit of a tax bill owing, and they're like, but I put money in my RSP. So first of all, make sure that the RSP is the right strategic tool for you during this tax season. And the second question is about the investment piece or not. What a lot of people don't think about is that you can open an RRSP that's not invested. So it can be in that one of those cash type products. I'm not suggesting that. I'm just saying, if that money is for a down payment and you don't want it to be going up and down right now because you need the money in sometime in 2018, you could put money into an RRSP that's not invested, that's in like a high interest rate RRSP or something, so it would be liquid and safe, and so you could pull it out for that down payment.
Yeah.
And then the other piece is, if that money isn't for something in the short run, and it is your long-term savings, don't let something like a correction make you afraid to invest for the long term. Like, don't let this sour your taste of what it feels like to invest. And that's something I'm saying to a lot of new time investors. Like, if this is your first taste of market volatility, welcome to the jungle. It's like that is okay, and it's par for the course. So instead of being terrified of it, be like, this is a learning experience. Like, let's just figure out what my risk tolerance actually is.
Yes.
And trust that, hopefully history repeats itself and markets go down and then they come back up.
Thank you so much, Shannon. And thank you for tuning in and bringing your questions. Shannon Lee Simmons, the founder of the New School of Finance, author of Worry-Free Money, and also a certified financial planner, a fee-only financial advisor, was nice enough to join us today to take all of your questions. So thank you for tuning in on the CBC News Facebook page on The Money, and I know we'll probably be back again soon to answer some more. So thank you. And thank you so much. This is great.
That's great. I hope it was okay that I said welcome to the jungle.
Yeah, absolutely, absolutely. Yeah, totally. No, that was great. And there were lots of questions coming in.
No, it's great.
So I think people are pretty interested.
It's the combination of potential rise in interest rates and market volatility. It feels like, oh my gosh, oh my gosh, oh my gosh. All parts of my life are falling apart.
Yes,
That's why.
I think you really